Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Mark Phillips, CEO of Harvested Financial for Options Expiration Week as we look to close out the first quarter of 2021. Mark, it's great to see you as always. Welcome back to Trade Talks. And it's quite incredible that we're looking to close out the first quarter already. It really has flown by for us.
It really has. I was thinking the exact same thing, Jill. And, it's incredible that we're already on our third expiration, closing out the quarter. And, if you look at where the equity markets have gone so far, overall, the big picture story is saying the major indices are up 6-7%. Maybe Russell's outperforming. We're seeing up 20% there. But that kind of belies all the turbulence that's happened. And I think, the last time we spoke on options expiration in February, we've seen some pretty active moves here since then. And whether it's the intraday moves, whether it's some of these like options related turbulence that's happening around expiration, there have been some violent moves. And, in the trading business, we like to say that the market takes the stairs up and the elevator down. But those elevator down moves have been sharp. And I think that really demonstrates a lot of the sort of fear and uncertainty that is existing in these markets, despite hitting all-time highs. So we are seeing continued support as these dips do fall. But the two things that I'm looking at right now in the options market to sort of inform some of this is the first is going to be the call skew. And that's one leg of the sort of kind of confusion out there right now, is that call skew is the idea where the upside out of the money calls are priced more richly than the at the money calls. So the implied volatility there is going to be higher, meaning the options premium are more expensive. And that comes from the simple reason that there are more buyers than sellers. There are a lot of upside call buyers that continue to see a lot of bullish potential in this market. And it's not necessarily just in some of these individual names. We're seeing that across indices too. So on the one hand, I'm seeing this call skew that's been fairly persistent over this past quarter. But on the other hand, we see some of the volatility gauges in the markets, whether you're looking at vol Q, whether you're looking at VIX, these have continued to drift down. We're not quite at the lows of where they could be, but compared to where these indices are when the markets are at all-time highs, there's a lot of persistent uncertainty out there. Typically, if we're looking at the VIX, like we're trading right around 20 right now, that can go as low as the low teens and single digits. And so there's a little bit of juxtaposition there between the markets at all-time highs, but some of this uncertainty, and you have a lot of call buyers. So, we're getting a lot of mixed signals out here in the markets, and I think that contributes to some of this choppiness out there.
And Mark, with investors seeing a lot of different narratives about the market right now, how can we parse this into a strategy?
Yeah, so, I think there are a lot of different narratives out there, and that's exactly some of the confusion right now as you're thinking about how to position a portfolio, whether it's for the long term or whether it's even just for a short term kind of trade. And so one of the other themes that I think we have out there too is this inflation question. So we're obviously just coming on the heels of that FOMC announcement. The Fed seems to continue to have a sort of dovish policy. But that said, we're also seeing massive government spending. We're seeing a $1.9 trillion stimulus come out. We're seeing a lot of supply on the Treasury side that is going to need to have some demand to meet that. So whether that's going to come from quantitative easing, whether that's going to come from adjustments to bank participation there, that's all uncertain. And so the inflation trade is also a question out there that's providing a lot of questions about the markets because, like I mentioned, sitting at all-time highs, that's a little bit confusing if you're going to use equities as a hedge against inflation. Typically, we think of stocks as a great way to sort of hedge your dollar value, that they're relatively protected against inflation. But the markets sit at PE ratios, that have a lot of people scratching their heads. And I think that's maybe why value's been underperforming for so long. But given this inflation trade, given where the call skews at, given kind of all of these factors that we've been talking about, it's a great time to think about sort of protecting and participating. And so what I mean by that is setting up a structure that would allow an investor to realize some of the potential gains, because there are a lot of potential reasons why this market might continue to drift higher. We just popped on some of these on the Fed announcement. But there are a lot of reasons why we could go down too. So, I can make great arguments on either side. I think anyone that tells you they really know is lying through their teeth. But looking at this kind of, desire to protect and participate, we're going to want to look to the options markets to set up a structure. I like to sort of call it a synthetic collar, or you can almost think of it as a DIY structured product where you set yourself up with a downside floor where your portfolio, your equity, however you want to set it up, will not lose any more than a certain amount of value. And in exchange for that, in exchange for having that insurance policy on the downside, you have to give up some upside. But this sort of contained, defined structure allows you to look at all these different narratives that are going on in the market and kind of set your portfolio up to participate in the upside and protect yourself on the downside because of, sort of all the mixed signals that we're getting out there.
All right, Mark, and to wrap up in the last minute here, what types of products does this work for, and where do you see this being the most effective?
Yeah, I think that's actually the beauty of this, is that it can be effective anywhere. That really any kind of underlier this will work for, whether you're looking at basing this off an index, whether you're looking at basing off an individual product. Of course, individual levels will vary. Mileage may vary, I guess is the expression, but depending on the overall structure, you can see some really interesting opportunities. And that's sort of the beauty, is how customizable this can be, and the sort of varying use cases that you have. So protecting and participating is a great way to think about all this uncertainty that's out there in the market, but still remaining active and still remaining exposed to some of the potential gains that there might very well be.
All right, Mark, we appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.